It doesn't matter what industry you're in, people skills are very, very important, and how you communicate. People with poor reputations have poor reputations. And again, this also comes down to productivity. Someone can be super productive and creative in 7 to 8 hours being highly motivated, and others need to sit there and spend 14 hours to work out the same thing.
Strategic asset allocation and tactical asset allocation, right? If you could tell us the difference between the two.
There is no overlay as such. My observation is that a private bank is a bit like a one-stop shop.
How does the decision-making process actually look like?
How robust it is, how are the decisions made, are those decisions consistent with what they've told us is in their investment process? That investment process from start to finish is the definition of all of asset management.
Do you think manager selection makes a big difference versus timing the market correct or adjusting the risk? There are different aspects to your performance, right? Which one is the most important? How much alpha do you think is possible to generate beyond your index?
Okay, it's a really good question. We had tariffs, not so many tariffs, tariffs again. Look, everyone can look at Bloomberg and say, let me just buy the most high performing stock that you have in the S&P. More often than not, they won't be able to tell you when to sell.
Do you think that people here are not really aware about it?
Can you see how it's building out?
We see a lot of finfluencers. This is a new Gen Z term that has come up, right? What do you think about that?
You can end up, gambling your life savings away.
As a woman who's starting out in the investment space, what would your advice be? Hi everyone, welcome again to the next episode of Unfiltered Investments. Today we have a very special guest. She's the first woman of our podcast and I'm very excited to welcome her. She's Mehvish Ayub. I run across into her at every CFA event. She's a board member of CFA and has 15 years of experience in the asset management space. She built her career in London and then came into a senior position and shifted here to Dubai. She brings a very deep expertise in asset allocation and portfolio construction, but also very real views on leadership, diversity, and how it is to be a woman in finance or investing in general. In this episode, we talk about her journey, how investing has evolved over time, and very real conversations about diversity. So please welcome Ms. Mehvish Ayub. Hi Mehvish, thank you so much for joining us. I have met you at CFA events. You're there everywhere and I know you're a board member now as well. And I've seen a lot of your, shots on Bloomberg and CNBC, what you talk about the market. So thank you so much for taking the time out.
I'm really happy to be here.
Yeah, the whole idea of doing this is obviously, to raise more awareness, let people know what's happening. And the best part is we have you're the first woman on our podcast.
Okay.
So thanks for that as well.
A lot of responsibility.
No, I'm sure. But this is also like a way for other women to come up and talk because, we don't have a lot of women speakers. And I'm sure you would also notice this being in the industry. But to start with, I want to know, how did you end up here in Dubai doing what you do?
So it's quite a long story. I started my career in London. So I was in investment banking for about 4 years. I did a brief stint in consultancy, but the vast majority of my career, 15 years, has been in asset management. And I very recently moved back to the sell side towards banking. Ultimately, what I've been involved in is multi-asset, portfolio management and advisory. So what that's looking at, either from a manager selection perspective or asset allocation or some quantitative element, bringing all of that together to manage a multi-asset portfolio essentially. But I would say that the investment banking experience was very different, a little bit far removed from actually client portfolios. The asset management and the consultancy was very good in terms of me understanding the manager selection process, which I did for 6 to 7 years. And then the stint in asset management as a portfolio manager was bringing all of those elements together, essentially. So what I'm doing now at a private bank is I'm head of managed solutions advisory. And what that means is a number of different hats. It's looking at asset allocation, portfolio construction for clients, and specifically being a fund specialist. So looking across our open architecture platform, what do we have in terms of public and private market strategies, and how do they fit into client portfolios? How do they improve diversification, risk-adjusted returns, and so forth?
So I want to know, did you always know that you wanted to be in the investment space, or how did you break in?
So I would say, starting from university, I was at LSE. And I think the natural gravitational pull there was towards finance. So we
Okay.
were being poached by a lot of the big banks and consultancies at the
Mhm.
time. But finance is a very sort of broad term, and
Yeah.
there are many different sub-industries and roles that you can have. So I wasn't even aware actually of the difference between front office and back office.
Okay.
So my first stint was actually front office at an investment bank. And that was very interesting, actually very much aligned with something that I had studied at university.
Okay.
But then as I moved throughout my career, I refined to the degree that I wanted to be involved in markets and be client facing in terms of the role. So I would say that, yes, I always knew I wanted to be in finance, probably started from my university times, but the role has evolved a lot. And I would say that the current role I have couldn't be done without all of the experience I've had in the variety of roles.
Yeah.
So, what I don't want anyone watching this to think is that I want to be in finance and I want to be a crypto trader. I want to be at a hedge fund and not understand the path it takes to get to that point. It can be very varied. And the more experience you have across different investment functions, the better you are in your end role.
Yes, I'm sure. So, just to compare, right, when you studied in London versus in Dubai, I think the awareness of what exactly happens in finance, in let's say investments, or some people go into trading, quants, hedge funds, and things like that, right, is much more easier to understand there because
Yes.
there's so many people who are already a part of the ecosystem
Yes.
as compared to here.
Yes.
So for me to even get into investments and learn what investments was after doing my CFA.
Okay.
So before CFA, I had no idea this existed, right? Because the ecosystem is not big here.
Yes.
So that's why I started this, so people can understand, and the ecosystem is also growing. But since you've been in London and in Dubai, what are some of the biggest differences that you see?
So this is an excellent question, and it's really important for people to understand. If you think about in London, if you start out, whether it's at a bank or an asset management firm, it's a flagship office.
Okay.
You will have hundreds of people on the same trading floor.
Mm-hmm.
You'll have a variety of investment roles. Okay. That is very different to if you go to a regional headquarter of that same firm based in Dubai or anywhere in the Middle East for that matter. You won't get the variety of roles. You won't get that understanding of the investment ecosystem. So let's just take, for example, a fixed income trading floor, fixed income and currencies trading floor. On that trading floor at an investment bank, you will have the portfolio, you will have the traders.
Okay.
In terms of the execution desk, you will have salespeople, you will have strategists, you will have your local economists, you will have the strategy and economist department, the research department broken down into many different levels. You may have equity research specialists, fixed income specialists. You don't get that extent of investment people on the floor here. So what you might get, actually, most of the regional headquarters, certainly for asset management, which is where my experience is predominantly business development, some marketing. Those that are more fully fledged out may have strategists in order to communicate what the investment strategy is to clients. But are the investment people here? Typically not.
Okay.
So I really do recommend for individuals born here, if you really want a taste of the investment ecosystem, the variety of roles, it really has to be outside of London.
Yeah, I agree.
It has to be New York, Boston, London, Singapore, perhaps.
Okay. Also, in terms of so now what trend we see is that people from London are shifting to Middle East to kind of execute what they have executed in London years back. So do you think that playbook is going to work and it's like a clear path to success, or what do you think about that angle?
So look, it's always encouraging. I think it's part of the UAE and the broader GCC growth story that you're attracting professionals.
Yeah.
It's difficult to say whether that group of professionals coming over is going to up the game. It may or may not. It all depends on the individual, the IP that comes along. There are a lot of different factors driving that transition. Just really the state of countries in Europe, the standard of living, the cost of living, opportunity set, and the fact that it's tax-free here. So I think it's difficult to say, but I think it's a good sign that there are more asset managers, more banks, there's growth. I think globally, when a financial firm looks at its profitability across different regions. It is identifying the Middle East
Yeah.
as one of those growth
That,
engines.
yes.
And therefore they are investing in the region. And over time, that should build a better ecosystem.
Got it. So what is the difference between the client profile in London versus Middle East? Because if London has such a big office, or any other, let's say, metropolitan city, right? They have such big offices. They have so many people. So what is the client profile like?
So it really depends on what clients you're used to dealing with. So
Okay.
you do have a lot of institutional clients in the UK, typically pension funds.
Okay.
Those were the clients that I ultimately dealt with.
Okay.
When I moved here, the range increased. So it was some of the institutions, more the sovereign wealth funds, but alongside that, family offices as well. And now the particular segment that I look after is high net worth and ultra high net worth. So the client base, I mean, you could be in the UK looking at wealth as well, or institutional, and similarly here. It's just that I think the institutional business there is more widespread across different pension funds, whereas here the money is concentrated in a few hands.
Okay, got it. And what is the good versus bad in this kind of client profile?
Look, both client profiles are very interesting. There's a lot to learn. I would say on the institutional side, typically they've had a lot of good advice from investment consultants and asset managers. So they tend to be, I would say, less hands-on in that they think about asset allocation. They think about investing for the long term. And this is really important in terms of how you construct your portfolio and how you run your portfolio going forward. Whereas I think on the wealth side, they should be investing like that, but the tendency tends to be a little bit more short-term in nature, trying to capitalize on short-term market corrections, being more tactical. And so I would say that, as far as I can see, is the biggest difference between the two client bases. But eventually, I think depending on the AUM that you have, you should be moving towards a more systematic investment in markets and having an asset allocation to guide you.
Being a woman in this industry, how is it like for you?
So look, when I started out in London, I didn't actually even notice the gender gap. I knew that I was one of few on the trading floor at the time, particularly in my department. But I was just at the time so focused and so ambitious, it didn't even occur to me. Like, you know, when you're really so like narrowly focused and you have a target of where you need to get to, and you don't really observe from a big picture perspective what's going on. I would say that would be the first 10 years of my career. Where I really noticed the change, and I think this happens for a lot of women, is when you become a mother, right? Or when you get pregnant, when you've got to have these difficult conversations about dependence. And this can not only be about children, this can be about elderly parents needing to care for them, taking time off, having that flexibility. And I think the more difficult decisions I had to take and have discussions about, I realized that's when the gender gap really came to the fore. So one of the decisions I took was actually to work a 4-day week. Once I had my children, and I did that for quite some time. However, my productivity was the same, if not more, than anyone working 5 days a week. Do I think now, when I look back at it, did it impact my career trajectory? Probably. I think that at the time it was just perceived as working less than others, even though that wasn't the actual case. Whereas I think male peers of mine would have been promoted and gone for more senior positions. So I would say that is really the step moment when I realized that there's a lot more to be done. And once I started having those difficult conversations, I think that whole concept around maternity, when you tell your manager and how much stress you take over it, I saw so many other colleagues and peers of mine going through the same. And that's when I was involved in the local diversity and inclusion initiatives. And we started to create these monthly investment networking sessions in order for senior stakeholders to be aware of what are the issues on the ground that women in the workplace are facing. Because the intention was always great, and I would say even the policies were there, but the practical implementation and those day-to-day conversations are actually very difficult.
Got it. So like let's say, okay, today I've just started my career, right? I'm 4 to 5 years in. I can see that difference, but I am based out of Dubai, right? So do you think that London and Dubai has a different way of looking at things? Because you didn't realize that in the first 10 years of your career.
Yes.
I am 4 years in and I can see the difference.
Yes,
So do you think the region has some part to play in it?
absolutely.
Okay.
And all I'll say on this matter is that there's a lot of work
Mm-hmm.
in diversity and inclusion to happen in the region.
Okay.
So I did feel that when I moved to the region,
Hmm.
it was a completely different kettle of fish. And I know of many of my peers here in the region. I never knew of anyone in London. And it's really disappointing for me, actually.
Yeah, I know. Not just you, I'm sure everyone in the industry. But do you think that mindset is changing?
Mindset is changing, but I think what really needs to change is whether it's men or women, right? If you're being mistreated, you have to speak up.
Yeah. True.
Okay. And there will be consequences to that.
Hmm.
But speaking up is really important.
Yeah.
Making sure your sentiments are heard
Hmm.
and understanding that at some point the stress on yourself is not worth it.
Yeah,
And just look for another position.
So now we'll come back to your journey to here where you are, right?
Okay.
So what skills do you think were important for you early out in your career versus what changed when you got into more senior and executive roles?
So what I'd say is earlier you have to really master the technicality of it.
Okay.
In whatever you're doing.
Okay.
And like I said, I did a variety of roles. So very initially it was foreign exchange sales, then options trading, and then I moved into manager selection, and then ultimately asset allocation and portfolio management. So the technical side is always very important, but you're never working in a silo.
Yeah.
And what I have realized, actually I've observed, it doesn't matter what industry you're in, people skills are very important, and how you communicate. So what I found towards the tail end of my career, as I became more senior and I was a portfolio manager, that if I wanted something done, I would not hide behind my screen. I wouldn't send an email.
Yeah.
And here, obviously, everyone WhatsApps.
Yeah.
And I wouldn't call someone. I would physically go to someone's desk and I would have a discussion about what needed to be done. And this is something I would really recommend, because I think that in this era of social media, perhaps people don't utilize this as much. But whoever you're working with, internally or externally, the FaceTime matters, and the relationship matters. And that does have an impact on whether the work that you need from that person gets done or not. Right? Now, that's if you assume that everyone is professional and takes time seriously, you shouldn't have to do that.
Yeah.
But the reality is not everyone is. And sometimes you just need to have that additional skill set. And then I would say that's just more in terms of how you work personally. And then there's how you work in teams. And this, I think, is where personally I think leadership here in the region is really challenged. Right? There's a very fine balance between being assertive and making sure the work gets done, but at the same time having empathy and really knowing what your team is going through, and adjusting according to that. Because one size does not fit all. And if there's anything I've learned with Gen Z, if we want to encourage the next generation to come into finance, we have to really hone in on leadership skills. And it really is about people management.
I agree with you.
And I think this is really missing in the region, as far as I can see, because the turnover here in most financial institutions is very high.
Yes, very high.
And it's very frequent.
Yes.
And people don't leave organizations, people leave managers.
Yeah.
So it really does boil down to leadership and management skills.
Yeah. The problem is also we don't have such a big ecosystem for you to move around very frequently. Right? Like, let's say, okay, you left certain firm because it didn't work out for you. You have maybe 5 more firms.
You have more options now.
Okay.
You have more options now, but we also know that the recruitment industry does not work as much on merit. Right? It's who you know, who you network with, how you get in front of people.
Yeah, true. Now that you mentioned Gen Z, I want to know, how has your experience been like with them?
So look, I've not actually worked with that many Gen Z.
Okay, got it.
Most of the people I work with are very experienced, but there's definitely a difference. And I just think it comes down to understanding that everyone is unique. When we think about cognitive diversity, I talk a lot about women. It comes from every angle. Your end achievement is not to get a better equality based on gender, based on race, right? Based on age. Your end result is to get cognitive diversity, right?
Got it.
And that just means that all of these sets of people, everyone is different.
Yes.
And I just don't understand how you can understand such a diverse group of people in age, race, gender, without having some empathy, without understanding what they're going through in their personal lives.
True.
You don't have to be a counselor, but you have to care.
Yeah.
And I think if you care and people can see that you care, they work for you out of respect and not fear.
Yes.
And this is how you keep people on.
Yeah.
This is how you get retention. This is also how you attract talent.
Yes.
People with poor reputations, like you said, this region is small. People with poor reputations have poor reputations.
Yes,
and people with good reputations have the ability to attract talent into an organization that previously had a poor reputation. Like people really do value this, but I don't think generally the industry, and specifically this region, understands this.
That's true. So my previous conversation with Obadiah, he told me very interesting factor. So he was like, people here are here to keep managers happy rather than doing what they actually know what to do best.
Interesting, yeah.
This is one of the points that he brought up, which was very interesting. So I want to know what you think about it.
It's an astute point.
Okay.
It's about understanding how important your manager is to your day-to-day.
Yeah.
Right? Now, if you're in a wider, more professional organization, you can network higher up.
Yeah.
You can have number of allies in the organization, and your manager is important, but they're not the end all. So maybe this is a reflection of the size of the organizations here in the region, and being aware of the politics of the organization. But at the end of the day, if your manager is not insecure and you are doing a phenomenal job, they should be really proud of you.
Yeah.
Right? But if they're insecure and you are showing them up, then you're not keeping them happy. It just depends. And I think this is the issue. I really think on DE&I, the intention is always there. Managers have been given some unconscious bias training.
Yeah.
But there needs to be a lot more work in actually translating it to a day-to-day experience for the team, which is pleasant. And I really understand actually how difficult it is when you've got numbers at you, you've got revenue targets. How do you manage that alongside ensuring everyone is happy and you don't have turnover and you don't have assets leaving? It's a very difficult balance.
Yeah. Let's say, what was the characteristics that you saw which was very common versus what did you wish people had that they didn't?
So they were, all those that had made it and survived were very technical.
Okay.
But also really able to stand up for themselves.
Okay.
And they were quite assertive. I didn't even have anyone outside of that.
Oh.
I didn't even have anyone outside of that. So I'm assuming there must be a lot of people when it comes to difficult decisions, especially when it comes to carer responsibilities. I know that the statistics are out there. A lot of women leave the industry.
Yeah. But do you think women have to become that way?
No, they shouldn't. That's what I'm saying. There should be a recognition. It's not just to do with women. There are a huge variety of different types of personalities out there.
True.
And each individual brings what they have as they are. Like I said, you are who you are.
Yes.
Brings their unique perspective to a firm. It's down to the manager to recognize how that person contributes. It might be in a different way to the way someone else contributes. And again, this also comes down to productivity. Someone can be super productive and creative in 7 to 8 hours, being highly motivated, and others need to sit there and spend 14 hours to work out the same thing. But a manager may not see
that way.
It may not see it that way. They'll see one person sitting there from like 7 to 10, which we know is the work culture in this region, and they'll see someone else there, but they won't look at the productivity as much.
True. I really hope it changes. I do see some things getting better, so I'm really happy about that. Like I see a lot of Gen Z or students now getting internship opportunities.
Okay, great.
Which wasn't there before when I
Here
started.
in the region?
Yes, here in the region. And I was so happy to hear because I didn't have that opportunity. Okay. So now that people are getting, I'm like, it's great. Because even the region, if it's growing, people should learn with it, right? Like they've also stayed here for so long. They've given their time to the country. It's also time they start contributing as well. If they move out to get jobs and then come back, I don't know. I look at it a different way. Like I'm happy to be here and contributing back. So I'm glad that people are getting that opportunity. So
It's a good sign because it means in order to offer an internship, you have to have sufficient
yes,
resources.
exactly.
You've got to have enough investment and business
Yeah,
development to
true.
train that person up.
Yeah.
You've got to have enough projects to give them. So it's a good sign of that ecosystem evolving.
Yeah, exactly. So that way I'm really happy. But coming back, so you mentioned that you've worked in asset management and now you're in banking, right? I want to understand, in terms of asset management, right? How does a portfolio or asset allocation look like for, let's say, an institutional client
Okay.
versus an ultra high net worth? Okay, what asset classes do they prefer? And if they are making any changes in the decision, how does that, like, why are those changes made or things
Okay.
like that?
So I think the important thing to talk about is different types of multi-asset portfolios.
Okay.
So clients have a variety of
Okay.
how their portfolios can be managed and what they choose.
Hmm.
Okay. So the first thing is, do you want something which is relatively low maintenance and more strategic in nature?
Okay.
And a lot of clients, end clients, and on the wealth side, particularly in the UK, this is how it occurs.
Okay.
You determine long-term capital market assumptions. Based on that, you create a diversified portfolio,
Okay.
and systematically on a quarterly basis, it gets rebalanced.
Okay.
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 Now, if you are reviewing that asset allocation, you'll do it perhaps on an annual basis. It won't be tactical in nature. Okay.
Okay.
And any changes in the macro forecast and the environment will be reflected in your capital market assumptions.
Okay.
And then come through in those annual changes.
Mhm.
Okay. Then there's another way of managing your portfolio, which is more tactical in nature. And this is where you have that core strategic asset allocation, where you know your split of assets, but you have the ability to be tactical.
Okay.
You have the ability to overweight on the equity, potentially underweight on fixed income, increase your allocation to alternatives, and that can be done on a monthly, quarterly, or whatever frequency you determine.
Okay.
Right? Typically, it's on a monthly or a quarterly basis.
Okay, got it.
And depending on where you sit, what kind of portfolio you prefer will very much determine your asset allocation and your portfolio management. So if we think about the construct, it's the same.
Okay.
But so your level of activity will change.
Okay.
Okay. Now, an institutional or wealth client can choose either way.
Okay, got it.
Right? They can choose either way. But what I've tended to see is the institutions can be a little bit more strategic in nature.
Okay.
Can be a little bit more hands off. And on the wealth, they want to be more tactical.
Okay.
Okay. And the frequency of rebalancing or taking trades can be quite high. But again, it's on a client by client basis.
Okay. So we'll just break down everything that we discussed line by line. You spoke about long-term capital market assumptions.
Yes.
What does that mean?
So that is your typically anything beyond 5 years, your long-term expectations of risk and return metrics across different asset classes.
Okay.
Okay. And this is the backbone of how you create multi-asset portfolios. And a lot of the different asset managers and banks will have their own way of coming to those capital market assumptions.
Okay.
But essentially what it is that in 5 or 10 years, typically it's the 10-year time frame.
Okay.
In 10 years, what is my expectation for equities on an annualized basis? And what is my on returns and risk?
Okay.
Okay.
Can you give me like an example? If I was to frame it or if I was to paint a picture, just
Sure.
an example.
So an example would be, let's say, global equities. You have MSCI World,
Okay.
which is a standard benchmark. Within that, you would say for most capital market assumptions, it would sit anywhere between cash plus 4%.
Okay.
Right? That's your growth return, right? And obviously that's dependent on what your cash level is and what your interest rate level is. And your expected volatility on an annualized basis is around 14%, 14 to 18%. Okay. So why is that important? Right? If we look at the last couple of years, what have we annualized in equities? Almost double-digit returns.
Yeah.
Right? Depending on what you look at.
Yeah.
Particularly over 2024. And year to date, we haven't ended the year, but we're looking at pretty good numbers. Right? So that is an outsized return on an annualized basis versus what the long-term expectation is.
Okay.
Now, why do we look at 10 years? We look at 10 years because 10 years is beyond an economic cycle.
Okay.
So what you're saying is if you look at the return of equities over 2022, which was negative, versus 2023 and 2024, and you average out the returns over that economic cycle, your long-term 10-year expected return should be around cash +3, cash +4%.
Okay. Got it.
Okay?
Yeah.
So then it allows you to judge what has been my return last year versus the long-term expectation. If it's outsized, you should expect
Yeah.
that it's going to mediate to that long-term expected return. And why do we look at 10 years? Because you want to build a long-term portfolio.
Yeah. Got it.
Right? Now, if I was only going to base my equity allocation on the returns over the last 2 years, okay,
Yeah.
it could be very high. I
Yeah.
could just expect that, oh, I'm going to average between 15 or 20% returns in equity. It's going to continue, which is the way investors think, right? They assume and they extrapolate recent trends into the future, right? But if you take it back over the long term, that has not occurred. If you just include 2022 and you look at your 3-year annualized returns, it comes down quite a lot.
Yeah.
Okay,
Got it.
so people need to consider the downturns as well as the upside,
Yeah.
and what is the annualized growth return over the long term you've achieved, and use that rate to decide what allocation you're going to have in your portfolio.
Okay. So, do these numbers change every year that you make an assumption? Like, let's say for 2022, if you make an assumption and you think it's cash +4,
Yes.
versus 2022, you think, okay, no, it'll be cash +2 or 3 or whatever. So, does
So
it
it
change
does
very
change a little
often?
bit, and every single bank and asset manager that produces these assumptions will have their own variation of how they do them.
Okay.
And some of them will look at it quarterly, some of them will look at it annually, and there will be adjustments. But broadly, the way that you calculate the numbers is about the same. So it's your qualitative tilt as to where you sit on that spectrum.
Okay.
But
got it.
really, the long-term return for, let's say, the S&P 500 has been around cash +4%.
Okay. And that's been continuing.
That has been continuing if you look at it
Yeah.
over decades,
Yeah.
right? Since we started looking at the data. And that's why it's so important when you advise clients to look at those long-term historical and forward-looking returns.
Yeah. True.
Rather than just what you've achieved in the last year. So if you were a prudent investor and you were looking at what you've achieved over the last 2 years in equity returns, you should be expecting that at any point there might be a correction, or that these returns will not continue like this.
Yeah.
And then how do I get adequate diversification?
Got it. Got it. So, is it very difficult to come up with these assumptions? Like, is there a lot of calculations?
Yes, yes. There's usually like a whole quantitative team behind it. So not everyone produces it, and there are a few asset managers and banks that are well known to produce these. And typically, a client who doesn't produce their own capital market assumptions might use another well-known asset manager or bank's assumptions to drive their own asset allocation. And these are also assumptions produced by investment consultants. So if we think about, well, this is very simplistic, the flow of money, right? You have your clients, whether they're wealth or institutional, sitting at the top.
Yeah.
They may or may not be advised by investment consultants. Investment consultants are typically more on the institutional side.
Okay.
The very large institutions, they will be advising them on exactly this. They will have their own capital market assumptions. They will build strategic portfolio based on their assets and liabilities.
Okay.
And then they may or may not recommend managers to invest in. Okay.
Got it.
This then gets split into asset managers.
Okay.
Right? Broad managers, right? Managers of money. And then the actual execution will take place in investment banks.
Okay. Got it.
And you hope that by the end,
yeah,
you've achieved more than what you put in.
Okay.
You've got, because you've got the appropriate
Yes.
advice. But I would say the investment consultant part is often missing for the wealth segment.
Okay.
Therefore, it then turns up to the asset managers or the private banks to provide that asset allocation advice. But it's very interlinked, because the investment banks also have the asset management arms.
I'm sure. Yeah.
Okay.
They're all.
Yes, and let's say on the private bank side, you will also get the manager selection side.
Yeah.
The open architecture that you also get on the investment consultancy.
Yeah.
So what I would say is, my observation is that a private bank is a bit like a one-stop shop.
Okay.
For an end client, whereas on the institutional side, you may have to go through many levels, an investment consultant, and then a variety of asset managers, and then eventually through to the investment banks for execution.
Okay. You mentioned about strategic asset allocation and tactical asset allocation, right? If you could tell us the difference between the two.
Sure. So strategic is like, let's say you have a 60-40 benchmark, 60% allocation to equities, 40% to fixed income. Okay. You decide up front that you're going to invest like this, and on a quarterly basis, you're going to rebalance. Okay, because if, let's say, equities over the first quarter have a 10%, are up by 10%, you're not going to have 60% in equities anymore. You're going to have more than 60%. And so what this does is strategically rebalance you back to 60-40 on a quarterly basis. There is no overlay as such. It's just systematically done. By the end of the year, you also want to be at 60-40. And what this encourages is that once equity markets have had a good run, it means you actually sell. And then you buy back the asset class that has perhaps underperformed versus equities. So it's a very good way of topping and tailing. I wouldn't say that you get the timing right all the time, but over a long-term basis, that's what the intention is.
Got it.
Okay? If you're being tactical, you have this core base, but you can say, I want to be overweight on risk. Therefore, I want overweight allocation to growth assets. Therefore, I will not be at 60% in equity. I will give myself a range. And again, it's very dependent on who you invest with and how those parameters are defined. But you could have, let's say, a plus or minus 10% range on various asset classes. Actually, I want to be overweight equity. I think it's a good run for equity. So I want to be overweight in the first quarter or the first couple of quarters of this year. And then it's your decision when you change from an overweight to neutral or to underweight. Now, if you extend that just within the equity universe, that can then extend to regional equities, styles of equity, size of equity. So you could be overweight global markets versus developed markets versus emerging markets. You could take a view, I want to be overweight European equities versus US equities. You could take a view, I would rather have growth type equities in my portfolio than value. You could have a view that at this point in time, I want to be overweight on small cap versus large cap. So you can see the extent of the decision making and the framework needed for that becomes very extensive.
Got it. So then you also mentioned about rebalancing, that usually institutionalized portfolios don't rebalance as much as compared to the...
No, the rebalancing is... the frequency is decided by every client. But what does happen is they tend to be more systematic. Right? The whole decision-making framework is a little bit more longer term in nature. So they tend to be more systematic and they will actually exercise the strategic side of it, the regular rebalancing more so than someone who is more tactical in nature. See, if I think about the decision-making process for the institution, some can be very fast, some can be very slow. There's a lot of red tape involved. You need your trustees to sit down and look at what's happened in the last quarter and decide whether they're going to change a manager, whether they're going to take profit on equity, if they're tactical in nature. So naturally, they tend not to be as tactical because the time frame required for them to make a decision is that much longer, right? But if you have the ability to take an investment decision in a shorter time frame, you have the ability to be tactical. But you have to be really wary of resources to do that, and you have to be wary of the ability. When you think about institutionalized portfolios and the construct, like the whole theory behind asset allocation, it's that you think of your long-term returns, determine your asset classes, determine your weightings, and strategically rebalance. You shouldn't have to be that tactical.
True. So does this also mean that if you are very tactical, you also incur a lot of costs?
You will incur transaction costs. You could be wrong.
Exactly.
Right? So I just think it's always good to be humble in markets. If there's anything we know is that we're always surprised. There's always something different to what was expected. And how do you navigate that uncertainty? So you can navigate that uncertainty by being reactive. And I'm not saying tactical is a bad thing. For those that have the resources, they can be tactical with a proper investment process and governance structure in place. Okay, how did you take that decision? What are your parameters? What are your liquidity requirements, perhaps? How do you transcend that through to client portfolios? So that's fine as long as you have the framework and the resources for it. But ultimately, it's less about market timing. It's more about portfolio construction.
Got it. So you were talking about decision making, right? Like, let's say if someone takes a longer time to make a decision versus if someone can make decisions quickly. So how does the decision making process actually look like from start to end?
So this is really determined by whoever is making the decision, the portfolio manager, what's the underlying asset class. Okay, so In multi-asset, it's a bit different. If you're
Okay.
managing an entire portfolio end to end with all the respective asset classes, you will have a framework in place,
Okay.
right? Similarly, if you are an active equity manager, you will have a framework in place,
Okay.
and you will look at your investment universe, whether it's one asset class or different asset classes, and you will have a process around that based on your style.
Okay.
So the investment process can vary depending on how many asset classes, what asset class, what manager, whether you're more active, whether you're more passive. That is the whole asset management industry.
Okay.
But it's me in sort of manager selection or understanding strategies that different asset managers have is looking at that process, how robust it is, how are the decisions made, are those decisions consistent with what they've told us is in their investment process. What you don't want is a manager who is more value orientated suddenly shifting into growth because growth is what's been working.
Correct.
Or you don't want a manager who defines themselves as large cap but sourcing all their alpha from small cap.
True.
Right. So it's about understanding, and that's, I think, a really good experience that I've had when I did manager selection in London. I did it for 6 to 7 years straight, and even now it's a large part of my role is not as much doing the due diligence but looking across what we have on the open architecture platform. How is one public markets manager different to another in their respective asset class? What is their niche? What's their differentiating aspect? So, that investment process from start to finish is the definition of all of asset management.
Yes. Okay.
But it's about what is your skill set? How do you assess? So let's talk about manager selection, right? What are you looking for? You're looking at the strength of the corporate, right? You're looking at their legacy in investing in that asset class. You're looking at the size of the team and the resources. Then you're looking at investment process, governance around that. You're looking at risk management framework, and you're looking at the end result, which is the performance. Okay. So you are assessing that across different managers, and they can vary a lot. But as long as it's in line with what they've communicated to you and it's coming through in that performance and it's there with regards to each asset class, because active equity is not the same as active fixed income. And what happens in the alternative space is not the same as what happens in the public market space. So you have to work with varying degrees of information, which is relevant to each asset class. But what you need to do when you're looking at due diligence is just have this standard of what you're looking at. And then over time, it's actually quite qualitative. There's actually another roundtable I did recently on infrastructure. And what I was describing is that manager selection in alternatives, it's quite different, right? I don't have the same level of transparency on the assets. I don't have the same attribution of returns. I need to do my due diligence on the manager very carefully. And there's a lot more qualitative aspect to the due diligence than what it would be, let's say, in the public market space, where I have information on all the underlying and I can see on a regular basis what the holdings are and I can see the exact attribution of returns.
I agree with you. So on a long-term basis, when you check your performance or go back, right, you monitor your performance, where do you think a bigger difference in decision is made? Like, do you think manager selection makes a big difference versus timing the market correct or adjusting the risk or things like that? Like the different aspects to your performance, right? Which one is the most important?
The most important is your asset allocation.
Okay.
The most important is having an asset allocation.
Okay.
Right? And this is actually something that a lot of the wealth market doesn't have.
Okay.
Unless they invest in a multi-asset fund of funds or multi-asset construct portfolio with another bank, they're not getting that asset allocation. So having an asset allocation is really, really important. There's a lot of academic studies on this, that this is really what is the main driver of your risk-adjusted return over the long term. Then within that, it's about where is your preference in asset classes? What is your manager selection? What is the strength of the open architecture platform? What's the variety of asset classes you have exposure to? But asset allocation is really, really key.
Got it. So this is just something that I'm curious about. Now that we spoke about public fund managers, right? Public managers. How much alpha do you think is possible to generate beyond your index?
Okay, it's a really good question, right? There's a trend in the asset management industry that we have a lot of assets flowing towards ETFs and passive management. Okay, so look, this has a space, and there are some ways of managing portfolios where you have all underlying passive investments and you just strategically rebalance.
Okay.
There are some where you can have some passive, some active, and there are some where it's entirely active. Now, where active makes a lot of sense
Yeah.
is when you have volatility and uncertainty in markets.
Okay. Got
Okay.
it. Yeah.
When you have difficult market scenarios to navigate, let's say the beginning of this year till now, we had so many geopolitical risk events.
True.
We had tariffs, not so many tariffs, tariffs again. We had hotspots of geopolitical risk in different parts of the world. You had an impact on energy prices, you have growth concerns, you have inflation concerns, right?
True.
So here an index is just going to follow a market cap approach,
Okay.
right? But if you, and again, why you should be looking at active managers is if you want to access investment ideas or secular themes before the broad market has tapped onto it.
Okay.
Okay.
Yes.
Or you want to add some diversification in your portfolio. So I could have and passive allocation to MSCI World, but I want to be active in emerging markets.
Got it.
Or I want to be active in a quality global equity manager, simply because it tends to be lower beta and more downside protection. So if I think that these equity returns are not going to continue, I will build my portfolio in a different way. I personally wouldn't just put passive constructs in it, because you're just going to go up and down with market sentiment. If you want to have some downside protection, you've got to think about, how do I use my allocation to fixed income? How do I construct my equity portfolio? Do I add hedge funds? How much diversification do I get from alternatives? These are all questions to be considered.
Okay, got it. So this would get me to the next question. What is the macro scenario like right now? And given this scenario, what is the best asset allocation to look at versus what are people doing right now?
So what I would say, it's less about thinking about, is there a standard asset allocation? Everyone has their own asset allocation.
Okay.
It's going to be determined by what's your return objective. One client might be happy with 6% annualized returns. One client might need 10% annualized returns. And they're willing to take much more risk according to that.
True.
So the point is, what risk are you willing to take? What's your downside risk you're willing to take? And that will determine what your asset allocation should look like. Should you have 40% in equities? Should you have 60? Should you have 80% in equities or growth-like assets? Okay. Where I think a lot of work needs to be done is having that asset allocation first. Okay.
Yeah.
And is having that asset allocation and then thinking about having adequate diversification.
Okay.
So then it's not enough just to think about 40 or 60% in equities. It's coming back to what's in my equity portfolio. So it's, what style do I have? What size bias do I have? What regional bias do I have? Do I want to be strategic? Or do I just want to be tactical and be able to take advantage of different market movements on a monthly or quarterly basis?
Got it. So you've mentioned that asset allocation is very important. Do you think that people here are not really aware about it? Is that a thing here?
I would say it's the biggest difference in the wealth and the institutional
space. Okay.
This is why I keep talking about it, because the answer to almost every, the panel of questions you sent me on investments, the answer is actually asset allocation.
Okay.
Right? Whether your macro environment is very positive risk sentiment or negative risk sentiment, or you foresee risks on the horizon, or you have inflation, you have stagflation, you have deflation. The answer lies in your asset allocation, right? The answer lies in not being reactive, but having that construct so that you are comfortable that your overall asset allocation mix has been stress tested over historical and forward-looking scenarios that you could get.
Got it.
And that it is managing your volatility. Look, everyone can look at Bloomberg and say, let me just buy the best-selling, the most high-performing stock that you have in the S&P, right? But what is the point of the industry? An equity research analyst, many of them will follow that stock, will give a view whether you buy, hold, or sell. More often than not, they won't be able to tell you when to sell. Right? So then it's a case of, well, I have that one stock. It's, let's say, in the tech sector. But actually, there's a lot going on in the healthcare sector. I should diversify. Right? and there's a lot going on in the industrial sector. How is Europe benefiting from the big change in the big fiscal view change that we've had in building out defense and infrastructure there? Well, then I'll add a bit of Europe, right? Can you see how it's building out from that one stock specific view to across different sectors, across different regions?
Got it. So, is it true that ultra high net worth clients don't really have a lot of exposure to asset allocation strategies?
So look, good banks and good advisors are thinking about asset allocation,
Okay.
and they're advising accordingly. And I
Okay.
think this is your differentiating IP.
Okay.
It's about how do you build a portfolio for the future, not for the past, not based on past performance.
True.
How do you have adequate diversification? How do you not overpay on fees?
Yeah, true.
Okay.
That is another thing.
And this is where the active passive mix comes into
Yeah.
it. Do you need to be active for everything? No, not necessarily.
Yeah.
So I just think giving that advice based off that anchor of asset allocation is important, and it is happening in region. It is happening in the wealth space. It is happening across banks.
Let's say now we come to when is the right time to make a change in the asset allocation. So let's say if there's a new macro news that has come out, right, that Donald Trump announced tariffs on different countries, right? How quickly should you make a change in your asset allocation? Or should you wait it out for some time? Or like how would you make a decision when a macro environment changes?
Okay, so this comes back to what I previously said. If you're strategic, you're not going to do anything.
Okay.
If you're tactical, you may consider.
Okay.
However, in this particular scenario, it's very unknown for some time. The impact on inflation,
Correct.
the impact on input prices for many corporates, the actual end state of tariffs was unknown for months.
Yeah.
Right? So it comes down to your investment framework. Do you want to take a tactical decision based on that? Or do you want to de-risk and wait it out? Because the initial reaction to the tariffs was actually very, very negative.
Yeah.
Now, there's another part of your question, which is to do with noise versus reality.
Yes, exactly.
Okay. So one thing we have to be aware of is that all economic data, just take economic data as an example, is quite backward looking.
Okay.
And then you have geopolitical risk events such as this, which no one really knows what the outcome is going to be until we're at the end of it.
Yeah.
What your job is, whether you're sitting in macro, whether you're a portfolio manager, whether you're a researcher or an economist, is to understand the big picture and the trends. So month to month data points are part of a broader trend. So what we tend to have in markets is something comes out and everyone reacts.
Yeah.
But actually, when you look at the history of that data point, it's not so bad.
Yeah.
Right? So the market reacts in one direction, then it reacts in a different direction. So what I'm trying to say is actually looking through the data over its historical trend, how it contributes to what was already perceived in the market.
Okay.
What's the market expectation versus what's being priced in? And that will drive whether you take a decision or not.
Okay.
But a lot of the time, what we're coming back to asset allocation, what we're trying to do for clients is have those more longer term strategic discussions about, well, this is your public markets portfolio. So let's start the discussion on alternatives and private markets, which are much more longer term in nature, which are illiquid.
Yeah.
And how do they diversify your portfolio versus events like this?
Yeah.
Okay, so that is the more important discussion to have on a longer term basis.
Got it.
But of course, clients want to be aware, well, what is your view? What is your house view on inflation as a result? What's the uncertainty? How quickly will we recover from this?
Yes.
And so forth. So there is, at that point in time, what I would say is you're probably better off outsourcing the reactive function to, let's say, a hedge fund.
Okay. Got it.
Than trying to take the view yourself.
Okay. Got it. So you spoke about public and alternative investments, right? Do you see the mix changing in the region?
Yes, absolutely. So again, it's a lot to do with education and awareness. So there's two things actually. It's changing in region and it's changing in clients. Clients as well. So the allocation in institutions is actually quite high on average, and it's very low. It's a very low starting point in the wealth segment.
Yes.
So there's a lot of growth to be had in the wealth segment when it comes to alternatives. And as a result, as the availability of products for that segment is more broad, as that extends across different subcategories of alternative asset classes, as those strategies have longer track records, we should, and there's education and awareness, you should see those allocations increasing. But typically it's actually been quite low because the minimum investment requirement was high in your typical closed-ended structures. And your ability to understand and even withstand the illiquidity in that strategy wasn't there. Whereas now with the evolution of evergreen products, you've seen a lot more interest in that space. And that's certainly been a very consistent discussion that we've been having, that I've been having with clients, that this is less to do with markets. This is more to do with your private versus public markets exposure. And within private markets, extend just beyond private credit and include infrastructure, include private equity. Think about that as a separate holistic asset allocation.
So there are funds now who have open-ended structures where retail investors can trade. And this is private funds.
Yes, these would be the listed structures. Yes.
Listed structures. Do you think for a retail investor, given the fact that it's being passed down after so many transactions already being done, does it still make sense?
The way it is let's say if a deal is sourced, there's an allocation for a closed-ended fund. There may be an allocation for a listed vehicle. And there may be an allocation for an evergreen. So it's the same strategy. It's just that there's just been an evolution in that space, that rather than listed, more managers are going through the evergreen. So the difference between evergreen and closed-ended is that closed-ended is you typically have your money locked up for 10 years. In evergreen, you'll have a soft lockup for 1 to 2 years, if at all, and then quarterly liquidity. But the way that they do that is that they have a portion of the fund in liquid instruments. 15 to 20%, because at any point in time they want to be able to fulfill their requirement of 5% of NAV, let's say on a quarterly basis, being redeemed back to investors. And for that they cannot liquidate the 80% of the portfolio in other assets, but they can liquidate that 20%. And naturally you will have 80% in the same strategy as a closed-ended, and you have this liquidity sleeve, which might, I would say, dampen your returns a bit. But at the same time, you have all your money invested on day one.
Yeah, that's true.
So the compounding impact of getting a lower return on an annualized basis could be quite powerful. Versus your closed-ended structure where you still have the J curve. You're still having capital called potentially for 1 or 2 years, and then you start realizing the exits.
So for a retail investor, because there are also 2 layers or 2 or 3 layers of fees that it comes down to, does it still make sense for a retail investor?
Yeah, no, I would say no. Look, the fees exist because there are huge networks and depth of resources involved, right? And certainly when we do our due diligence on alternative managers, there's a reason why they are the size that they are, the large key names that we think about. There's a lot of resources. We can see it in their servicing of us. And you've just got to look at the end return net of fees. This is an issue where clients think about, well, the more complex a product is, whether it's on the hedge fund space, whether it's on the alternative space, oh, my fees go up. But you don't look at the fees. You look at your net return and you look at your net risk adjusted return. Right? So a lot of people question, for example, hedge fund fees. Yes, your absolute return might not be that great, but depending on which hedge fund manager or group of hedge fund managers you've chosen, it's your risk adjusted return. In the long term, you are getting an equity-like return with the volatility of a bond index. That's what you're getting. That's what you're getting. In the alternative space, you are also getting very dampened volatility. Obviously, given the fact that there's less mark-to-market risk in an illiquid asset, you are getting dampened volatility with typically a slightly higher return over public markets on a long-term basis.
Got it.
And you should expect some illiquidity. Like the point of investing in alternative and private assets is to harness that illiquidity premium. So you should not go into a product thinking it's liquid when it's not. Because that is the exact premium you're trying to harvest. So as long as clients are aware of the structure of the product, the fact that you may have a 1-year lockup, you may have an exit fee in the first 1 or 2 years, and even then you have quarterly liquidity thereafter, which is better than none. You should be comfortable going into it.
Got it.
But be aware of the illiquidity.
Got it. But are the fees compressing, or is it still
No,
the
I
same?
think this is the one area where I think fees are certainly on the wealth side, they're not as compressed.
Okay.
But you are accessing a complex asset class,
Got it. Yeah.
which is illiquid.
Hmm.
And there's a lot of resources and a lot of structuring required for that.
Yeah. Okay. So next I want to talk about is media consumption. We see a lot of influencers. This is a new Gen Z term that has come up, right? Out there in social media platforms like Instagram or TikTok. What do you think about them?
I don't follow any.
Okay.
Okay. I do think the way financial news is being consumed
Mm-hmm.
is very different now.
Okay.
In my generation, I think we're not aware of what others are consuming, but certainly I think you have to be really wary of influencers. You have to look at their background, you have to look at their knowledge in the financial space, the degree of research. They obviously, acting on their own, cannot have a network that a financial institution has,
Yeah.
cannot have an investment process.
Mm.
So you have to really be careful who you follow. And I would always say try and do your own research. But if you are not a finance professional, there's doing your own research or there's delegating appropriately.
Yeah.
So I know it's easier to watch a TikTok video for 1 minute than read a Bloomberg article,
True.
but try and do some of your own research.
Yeah.
I do think, though, that overall, not just this region, I mean, this region specifically, but also social media means that our attention spans are very short.
Yeah. I agree with you.
And so rather than a long article, it may be more effective to do a short video. It may be more effective to bring the human side
Yeah.
of investing. Who are the people in charge of the big organizations? What's been their journey? How are they thinking about things, like tackling financial news in a different manner? And I think that would be driven by the next generation, the youth, and how they want to consume. That should over time shape what we start to see on our screens.
Okay. Do you think big organizations would now try to capture this space in the sense that they would also put their information out in form of like these short form videos or things like that?
Yeah, they already are. I think some of the organizations are using Instagram.
Yeah.
They are posting a lot on LinkedIn and YouTube. They are editing and shortening the content. But it's still, but you see, there's a process, there's a team behind that.
Yeah.
Whereas what the influencers are doing is just going on TikTok for 10 seconds.
Yeah.
So it's still a very different, like you can play in the same space, in the
Yeah.
same social media space, but the consumption of what the influencer is putting out is still going to be very different. And the thing is, we just need to be, I think anyone consuming it just needs to be wary of the content, the research behind it, the logic, the credibility. I know that the UAE has very recently come up with regulation alongside other sort of Western democracies, such as the UK, on having a license if you are going to be an influencer.
Yeah.
Because there are stringent regulations around what you sell and ensuring you don't missell any products. So that is going to extend to them. So that should hopefully add some layer of protection and make them more accountable for what they say.
But obviously, if we're talking about something so complex, it is going to be boring. And people don't like watching boring videos, whereas
They don't.
whereas influencers per
You're
se,
competing with. I watch Instagram memes all day long, all funny stuff. It has my attention, right?
Exactly.
And then for work, I have to sit and read some research, or look at Bloomberg videos, or look at YouTube videos from interesting strategists or political researchers.
Got it. So, like, I personally think that the kind of content you consume makes a big difference. And so, I think this finance content that is coming out is fun for me personally.
Okay.
Because I think that I'm still in touch with what's happening in the industry.
Okay.
The information might not be true.
No, but you are an investment professional. You're a CFA charter holder, so you're able to distinguish between what is correct and what's not correct. My concern is people who don't have the background feel like they are suddenly traders by watching this content.
Yeah, that's true.
And then you can end up, gambling your life savings away.
Yeah, that's true. That does make a difference. So this would bring me, I know you hear a lot of podcasts. And thank you for coming here. But I know you also consume a lot of podcasts, right?
Yes,
You like listening to podcasts.
I do.
Yeah.
I'll tell you my favorite podcasts: Empire
Okay.
and Diary of a CEO.
Okay. Got it.
And occasionally listen to some Bloomberg podcasts on finance and another well-known investment bank.
Okay. Any episode in particular that has your attention and something you didn't forget?
I mean, Diary of a CEO has a lot on there. I can't pinpoint. I mean,
Yeah.
I feel like it follows the host's interests.
Okay.
So initially, I started listening to it to be in touch with Gen Z. What are the apps out there? What are the new authors out there? What are the topics being discussed? But it has taken a very strong health turn recently. Yeah, I wouldn't say any singular episode, but those two themes are something that resonate with me.
Okay, got it.
I do like. There was one really interesting episode on the founder of Calm.
Okay.
So Calm is an app which has sleep meditations,
Yes,
board
I've heard of it.
meditations.
Yeah.
I found that very useful when I was traveling a lot. I could use it in the lounge and have like a 10-minute nap when I wanted. So I think those aids for people in this stressful environment are very useful. But Empire, overall, I just love it for the historical context. I think it's a really good podcast. Just, very basic things of when was tea first consumed?
Yeah, I saw that post on LinkedIn.
You saw my post on
Yes,
LinkedIn.
I did.
We say history doesn't repeat itself, but there was one particular episode on the consumption of tea in the UK and how the UK was importing so much tea from China that it had a huge trade deficit.
Yeah.
And to counteract the trade deficit, this was the start of the Opium Wars.
Oh.
What does it remind you of? The tariff situation with the US.
Oh my
The
God.
trade deficit with China.
Damn, that is so cool.
And generally that podcast just has really interesting snippets of information. So for example, there was I can't remember now the name, but there was a box created which allowed the transport of different plants in ships, able to survive months and months of journeys, and then how that transportation of plants went from one continent to another and then actually shaped how that region looked going forward, how all this vegetation was transported around the world, and how it ended up shaping, for example, what Bangalore looks like today.
Oh, wow. That is very interesting. Very, very interesting. I'm definitely going to start hearing it.
No,
tonight.
Empire. And there was another very, there was a series. So what they do is different series. So there was a series on the Mughals. There was a series on the on the history of India. And there was another series on female leaders in the past.
Okay.
And there was a really fascinating episode on Cleopatra.
Okay.
And how she essentially had her own cruise ship on the Nile.
Oh, wow.
With an inbuilt equivalent spa, an amphitheater. We didn't even know ships that size were being built at that time. How apparently, and this is documented by a Roman general, that actually it's documented in history how he observed automatic doors, obviously not run by electricity, but a pulley system under the floor.
Wow.
But this was the extent of, how she lived and what her realm was like at the time, whereas we don't know about it. We just so anyway, it was a very good podcast.
No, very good. Last question.
Okay.
As a woman who's starting out in the investment space, what would your advice be?
So my advice would be to hone in on your skills, learn from everyone around you. Just be in a learning mindset. Okay. Someone told me very early on that your career is a marathon. It's not a sprint.
Yeah.
Initially, when I started out in investment banking, I just want to get to MD in my early 30s and retire. Now I'm not of that mindset. Now I want to be learning forever. I want to be surrounded by investment professionals. I want to be in that type of environment, right? Otherwise, I'd just be bored. So take it as a marathon, and whatever situation you're in, which sometimes is not ideal in this region, as we've discussed before, still try and see how you can continue to learn, because ultimately it's your skills and how you learn and how you manage difficult situations which is going to get you out of that situation into a better one.
Yeah.
Okay, so just treat your career like a marathon, and if you can, build a network.
Yeah.
I know people talk a lot about, is a network really worth it, but I do think in this region it's very valuable.
Yeah.
Whether it's a male or a female network, build allies around you within your organization, outside of your organization, people you can turn to in difficult spots so you can navigate those difficult moments in your career.
That's true. But thank you so much.
Oh,
Thanks a lot. I had lots of fun discussing this. Thank you so much.
Great.
Okay.
The views expressed in this podcast are personal opinions, meant for educational purpose only, and do not constitute financial advice. Please consult a licensed financial professional before making any investment decisions.